Hello class, welcome to part 2 video. And before we start the classroom exercise 5.2, let's have a look on the notes to financial statement. So what is notes to financial statement? These notes provide additional information and detail that are not mentioned in the main financial statement. For example, those information not in your statement of comprehensive income, statement of financial position, statement of changes in equity, and statement of cash flow. The following are the information that will be included in notes to the financial statement: accounting policy use, significant assumption and judgment, breakdown or explanation of the item in the main statement, significant event, material event, proposed final dividend. I think this will be the one that we will commonly use in our exercise, and any other information that may raise financial statement user concern. So let's go through this exercise, classroom exercise 5.2. TCP Limited is a limited liability company and its financial year ended is on 30th June 2020. The following is the trial balance of the company at the year ended date. So you can see this is the trial balance. And the following are the events and transactions that may require adjustment on financial statement. So these are the adjustments that we are going to handle later. And based on the above information, we are required to prepare 4 statements, which is statement of comprehensive income, statement of changes in equity, statement of financial position, and notes to the financial statement, if any. And for a better presentation, I will show my answer in Excel, and the adjustment will also indicated here. So let's look at the adjustment. The value of inventory at 30th June 2020 is 400,000. So this will be our closing inventory. The fair value of land as at 30th June 2020 is 1.68 million. So let's have a look on the value of land. So the land value is 1570. So meaning that, so this is classroom exercise 5.2. So this is second adjustment. It means that the land value from 1570 to 1680. Am I right? Yes. So this is an increase in the value, and increase by how much? 110. So double entry for the increment, we have to debit the land account by 110 and credit to the revaluation reserve 110. So where we will show this, in our other comprehensive income. And we will show this event in the statement of changes in equity. So let's reflect this adjustment in our trial balance. Land value increased 110. And do we have any revaluation reserve here? Yes, so we increase 110 as well. So these two are the adjustment. We add 110,000 in the land on the debit, and we add another 110,000 in the credit of revaluation reserve. This is the double entry for second adjustment. Third one, the useful lives of motor vehicles and machinery are 5 and 10 years respectively. The depreciation expenses shall be included in administrative expenses. The company used straight line method to calculate the depreciation. So the second adjustment is regarding the depreciation. So we have first depreciation, which is motor vehicle. Second depreciation is for machinery. Let's have a look on the cost of the motor vehicles. And the cost of motor vehicles is 180,000. The cost of machinery is 280,000. So 180,000. This depreciation we are using straight line method, and for straight line method we use cost minus scrap value divided by the useful life. And for this exercise, the examiner is silent on the scrap value, so we assume the scrap value is 0. $180,000 divided by 5, we get 36,000 here. 280,000 divided by 10, 28,000. So your total depreciation will be 64,000. So double entry, we debit the administrative expenses. Why we include in administrative expenses? We follow the requirement. They say that your depreciation expenses shall be included in administrative expenses. 64. We credit the accumulated depreciation of motor vehicles. 36. We credit the accumulated depreciation of machinery, which is 28. So the next step we are going to do is we reflect this adjustment in our trial balance. So administrative expenses, we add 64 here. And then for the motor vehicles, accumulated depreciation of your motor vehicles, we add 36,000. For the accumulated depreciation of machinery, we add another 28,000. So you can see that by doing the adjustment, your trial balance is still matched. Next, we look at the number 4 adjustment. Included in administrative expenses, there is a payment of fire insurance amounting to 24,000, which cover a period from 1st January 2020 to 31st December 2020. So let's have a look on this. So the financial period for the company is from when to when? Up to 30th June, right? It means that this is start from 1st July 19 to 30th June 20. And this fire insurance cover the period from 1st of January 20 to 31st December 20. And the cost of this fire insurance is 24,000. So from here we can understand that the company paid the expenses which is beyond the financial period, right? Because the financial period is up to June, but our payment is covered up to December. So we have a prepayment. So how we calculate the prepayment? We use 24,000 divided by 12 times the prepayment period. So when is the prepayment period? First, we can draw a line So financial period is from 1st July 19 to 30th June 20, and our fire insurance cover the period from 1st of January 20 to 31st December 20. It means that the prepaid amount is here from 30th June to 31st December, which is 6 months. So here we multiply by 6 to calculate what is the prepayment amount. Answer 12,000. Next, we are going to show the double entry for this 12,000. So we debit the prepayment account 12,000 and we credit to admin expenses by 12,000. So let's reflect this in our trial balance. We have a prepayment 12,000 on the debit, and then your administrative expenses. We have to write credit, right? But this amount is on the debit, so we use minus 12,000. Next, the company has yet making the payment of commission amounting to 32,000 to its sales agent. This amount will be paid on 31st July 2020. Commission expenses has been grouped under distribution cost. The company not yet paid, but this commission expenses is related to the financial year June 2020. So what shall we do? We have to do a accrual, because this is the expenses related to current financial year but unpaid. So here we write accruals. Accruals by 32,000, and then this amount adjust to the distribution expenses 32 as well. Next, one of the trade receivables amounting to 30,000 has declared bankrupt recently. The management decided to provide a 2% provision for doubtful debts to its net receivables. All the bad debts and related expenses shall be grouped under administrative expenses. So we take a look on the company statement of financial position. First, we look at whether we have any provision for doubtful debts for the previous year. No, we don't have. So we have to treat this as the first year provision for doubtful debts. So this will be the adjustment number 1, 2, 3, 4, 5, 6, number 6. So this is the adjustment number 6. So first we recognize the bad debts. What is the bad debts amount? The bad debts amount is 30,000. So the double entry for this bad debts is we debit administrative expenses. Why we debit the administrative expenses? Because it says that all the bad debts and related expenses shall be grouped under administrative expenses. And then we credit to our trade receivables, because the trade receivables value has been decreased by 30,000. Next, the next one is first year provision for doubtful debts. How we calculate the provision for doubtful debts? We use our trade receivables minus bad debts, if any, and multiply with the rate of provision for doubtful debts. So what is our trade receivable during the year? Our trade receivable is on the debit 267,900. So 267,900 minus 30,000 times how many percent? 2%. $4,758. So 4,758 will be the provision for doubtful debts during the year. Let's check again the answer. Yes, our answer is correct. 4,758. So double entry. We debit the admin expenses and we credit to provision for doubtful debts. 4,758. Right, let's reflect this in our trial balance. So we debit the admin expenses. Sorry, we record the bad debt first, the 30,000. So admin 830. Our trade receivables minus 30. And admin add another 4,758 and we add another provision for doubtful debts, 4,758. Next, the management has paid 50% of the preference share dividend to its holder. The nature of the preference share is cumulative. Cumulative means that we have to pay in next year if unpaid. The nature of cumulative preference share is we have to pay in next year if we unpaid during the year. So let's have a look on our trial balance. So here we have a preference share dividend 13,000 and this is already paid one. So we have to calculate what is the total preference share that we have to pay and what is the remaining unpaid portion. So this will link to the preference share dividend here. So number 7, preference share dividend. The preference share of the company is 260,000. The dividend per preference share is 10% of its value. So we multiply by 10%. So we get 26,000 as the total preference share dividend. And during the year, we have paid 13,000. How to get this 13,000? From here, 13,000. So the unpaid portion will be 13,000 as well. So double entry for this unpaid 13,000. We debit preference share dividend. Credit goes to accrual. So let's reflect this in our trial balance. For preference share dividend, we add another 13,000 here. For the provision for, so we add another 13,000 at the accruals. Next, the management proposed a 4% final dividend to its ordinary shareholder. The dividend is expected to pay on 31st August 2020. So let's calculate this. Number 8, propose final dividend. The proposed final dividend is based on 4%. So let's have a look on the ordinary share. The value of ordinary share is 750,000. So we use 750,000 times 4%. When your dividend is based on a percentage, you use the monetary value. If your if your dividend is based on the number of share, you have to get the number of share first before you calculate the dividends. So answer, $30,000. But this 30,000, we no need to record in the financial year 2020. Why? Because it's a proposed final dividend. However, we have to show in notes to the financial statement. We no need to reflect this transaction in our statement of changes in equity, but we have to show this in our notes to the financial statement. Continue. So management decide to transfer 10,000 from the retained earning to general reserve, and this one we will handle when we're doing statement of changes in equity. I think I better use the full words because same as SOCI, right? We do in changes in equity. You can make a circle so that you can avoid this one we haven't adjusted. And last one, the estimated corporate tax for the financial year ended 30th June 2012 is 45,000. So for the estimated corporate tax, we can have a look here. Turn to page 70. Here saying that how to recognize your corporate taxation. We debit the corporate taxation and this amount is under SOCA and credit to tax payable. $45,000. This amount will be included in our income statement of comprehensive income, and tax payable will be in our current liability because this amount will be paid in the next 12 months after the year ended. So basically we have adjust all the information except for the last two, the last number 2, because this will only reflect when we prepare the statement of changes in equity. So let's take a break here and we will continue our preparation of statement of comprehensive income, statement of changes in equity, and statement of financial position later. Thanks for watching.